Assalamu alaikum wa rahmatullah.
Walaikum assalam, sir.
वालेकुम सलाम सर।
Hey, Janab. Khairat se. Hamad, how are you? Hamad, are you listening?
अस्सलाम वालेकुम सर।
Wa alaikum assalam.
सर
Wa alaikum assalam.
सर हानत कह रहा सर ग्रुप में नेट इशू है।
नेट इशू है, उसको आवाज जा रही है कि नहीं? All right, so this is our final chapter of this course. I will try to cover as much as I can, and all whatever we cover in this chapter will be included in your final exam. This is chapter number 7 of your book. No, sorry, it is chapter number 8 of your book, not 7. Chapter number 8. It is chapter number 8 of your book, which is an introduction to asset pricing model. Specifically, we'll try to understand the capital asset pricing model. Now, what is, you can say these pricing models, actually these pricing models help us in determining the rate of returns that any security, if we want to evaluate, so how we will be able to calculate the rate of return of that security. But before you can say understanding this capital asset pricing model, we will be required to understand the capital market theory. What is the capital market theory and how this capital market theory have evolved, and on the basis of that capital market theory this asset pricing model have been derived. When we are talking about theory, keep in mind when all of the theories are always working on some set of assumption. Why do we apply some assumption? We apply assumption in order to understand the phenomena and in order to understand the factors that are actually affecting that phenomena. So, like for example, in economics, you would have seen mostly one of the assumption is used in most of the economic theories, and that is ceteris paribus. That is other things remaining, you can say same. Other thing remaining same. It means other thing remaining unchanged. So what will happen? So other things, whenever it says other thing remaining unchanged or remaining same, it means they are applying some set of assumptions. Same kind of set of assumption we have seen that in our efficient market theory as well. We have applied some assumption, and right here in the capital market theory, we will be also talking about the 8 assumption that are applied on the capital market theory, or the theory is based on these main assumptions. So we will be, you can say, in order to understand the capital market theory, we will be covering 2 points. Point A is capital market theory assumption, and then point B is about the risk and returns relationship. These are 2 things that will help us in understanding the capital market theory. So assumption number 1 is that all investors are Markowitz efficient investor who want to target point on the efficient frontier. We have just covered, you can say, our efficient market frontier in the last lecture, and you have seen that we were talking about efficient frontier. Usually it is this type of portfolio frontier, and you can find that all of the, you can say, portfolio lie in this thing. And I have told you that whenever investor is targeting any portfolio, they are targeting the portfolio along this line, right? And you will see that most of the time the portfolio is considered to be the best portfolio lying right here in this section. And why I'm saying about this section, because you can find out this section is steep and this section is flat. So right here the risk is increasing but return is not increasing, and right here you can see this is the maximum return with the lowest, you can say, risk that is available in this portion. So that's why whenever we are talking about capital market theory, we are taking an assumption of Markowitz efficient frontier, that all the investor, it means all the investor who are operating in capital market. Now, what is capital market? We have already, you can say, discussed this definition of capital market, that it is a place where capital securities are bought and sold, and we say, you can say, a handsome amount of people are willing to buy and sell those securities. So whenever those people who are buying those security are the people who want to maximize their profit. So they are profit maximizing investor, and all of these investors are Markowitz efficient investor. It means that they would like to purchase a security with the highest return and lowest possible risk. And for that, they will be considering efficient frontier. All right, so this is the first assumption of capital market theory, that all the investors are profit seeking, profit maximizing investor, and they want to invest in a portfolio which will provide them a maximum return with the lowest possible uh, risk. The exact location on the efficient frontier and the specific portfolio selected will depend on the individual investor utility function. And you have seen that whenever we are talking about the exact location, so we have also seen that there are two, you can say, combination of the investment portfolio. If this is an efficient frontier, so we will see we have to find out, for example, where is tendant of the, you can say, utility function of any investor. So for example, if this is efficient frontier, EF, and this is utility of, you can say, any investor, so we'll find out this will be a location which will be selected by this investor, because right here in this location the investor will be able to get the maximum return with his or her acceptable risk exposure. He does not want to take more risk than that, this point. So on this maximum, you can say, risk, he is getting this maximum level of returns, and that's how it will become his or her, you can say, this selected pinpoint or location of the efficient frontier. Now, the second assumption is investor can borrow and lend any amount of money at risk-free rate of return. Can anyone tell me what is risk-free rate of return? We have covered this risk-free return in chapter number 1. Can anyone recall what is risk-free rate of return?
सर ऐसा ऐसा रिटर्न जिसके अंदर रिस्क के लिए आपके एडजस्टमेंट ना हो, रिस्क प्रीमियम एडजस्टेड ना हो.
बिल्कुल, कोई भी
गवर्नमेंट ऑफरिंग
जैसे गवर्नमेंट की सिक्योरिटीज होती हैं,
गवर्नमेंट सिक्योरिटी और रिस्क फ्री. लेकिन यहाँ पे हम क्या कह रहे हैं कि जो the investor have the ability, or the investor is allowed to borrow as well as investor can lend. Lending is, you can say, no problem. There is no problem in lending. Why? Because, for example, if you are buying a risk-free security, just like you can say treasury bill, so actually you are investing or lending on the risk-free rate. But for borrowing, this assumption is being made. Like, for example, in order to understand the capital market theory, we have to assume that investor have also the ability to take a loan on the risk-free rate as well, right? It is always possible to lend money at the nominal risk-free rate by buying the risk-free security, but it is not always possible to borrow at this risk-free rate. But later we will see that higher borrowing rate does not change the general result, right? But like for example, in order to understand this phenomena, we are just applying this assumption that investor can borrow. Once we understand this phenomena, so later on, whenever we are relaxing this assumption, we will find out it does not bring any significant change into the capital market theory, right, or the practice. So this is the second assumption. The first assumption was that all of the investors are Markowitz efficient investor. It means that they want to invest on that efficient frontier. And the second assumption is that investor can borrow and lend on risk-free rate. The third assumption of the capital market theory is all investors have homogeneous expectation. What is expectation? It is means the expected return. So the expected return is usually calculated or based on the probability, right? What is expectation? Expectation is always derived on some probability. So whenever we are talking about homogeneous, homo means same. Homogeneous expectation, it means that all of the investors are actually applying same type of probability. For example, we had, you can say in chapter 1, we have tried to understand, for example, we say there is possibility to earn 10%, there is possibility to earn, you can say 15%, and there is possibility to earn 25% return, right? For example, these were different, and we have said this is, or let's say, for example, let me take this one out, and let me say, for example, this is 5%. So it is in economic depression. For example, we say if the economy is in depression, so we will be able to earn at least 5% on this security. If things are normal, so we will be able to earn 15%. And if things are optimal, or you can say, we say boom, if there is boom in economy, we will be able to earn a maximum of 25%. These were three different scenarios we have tried to understand in chapter number 1. Then we have said that there is possibility. What is possibility of depression? What is possibility of normal condition? And what is the possibility of economic boom? So for example, we say there is 10% possibility, it means probability. Now I'm talking about probability. These are probability and these are returns, right? And then I say there is 75% possibility that things will remain normal, and there is only 15% probability that the economy will be in its boom. So now we are talking about these possibilities that not only me, but all of the investor. See, we are talking about all of the investor. All of the investor are homogeneous. Homogeneous means all of the investor are actually applying the same probabilities for the expected return. So that's why we say they estimate identical probability distribution for the future rate of return. That all of the rate of return which is available into the market, they are assumed to be calculated or based on the same probability assigned by all of the investor. Although this is an assumption and different people may have different, you can say, subjectivity towards of the different conviction that whether the things will remain normal or the economy will be in boom. समझ आ रहा है? अगर कोई कहीं पे अगर आपको समझ ना आए तो काइंडली क्वेश्चन कर लीजिएगा, ठीक है? तो 3 एजम्पशन हो गई हैं। पहले ये सारे के सारे इन्वेस्टर क्या हैं? प्रॉफिट मैक्सिमाइजिंग इन्वेस्टर हैं और वो मार्कोविट्स एफिशिएंट इन्वेस्टर हैं कि वो एफिशिएंट फ्रंटियर पे अपनी चॉइस करेंगे, एफिशिएंट फ्रंटियर पे। दूसरा हमने कहा था कि वो बोरो भी कर सकते हैं और लेंड भी कर सकते हैं, कौन से रेट पे? रिस्क फ्री रेट पे, ठीक है। और तीसरा ही जो हमने एजम्पशन लगा दी, अभी 5 बाकी हैं। तीसरी जो एजम्पशन हमने लगाई कि जो प्रोबेबिलिटी असाइन हो रही है रिटर्न्स के लिए वो एक जैसी है, होमोजीनियस है। The fourth assumption is all investors have the same one period time horizon such as 1 month, 6 month or 1 year. जब हम रेट ऑफ रिटर्न्स की बात कर रहे हैं तो हम कहते हैं कि सब तमाम जितने भी इन्वेस्टर हैं, all the investors are actually determining the return for same period. Same time horizon means same period. For example, if we are calculating the monthly return, so we say all of the investors are actually concerned about the monthly return. Whenever we are talking about quarterly return, so we will say all of the investors are actually concerned about the quarterly return. And whenever we say that investor, we are calculating annual return, so we will say all of the investors have the same time horizon that they are calculating return for the whole 1 year. So this is an assumption. A difference in the time horizon would require investor to derive risk measure and risk-free assets that are consistent with their time horizon. Although whenever we are changing this thing, for example, you can find out whenever we are talking about 1 month, so you see the risk exposure is different. And whenever we are talking about 1 year, the risk exposure is different. For example, if I ask you to lend me 100,000 rupees for 1 month, right? I'm asking you to give me a loan of 100,000 rupees for 1 month. In other scenario, I am asking you to lend me 100,000 rupees for 1 year. Right here, I'm promising to return it back after 1 month. And right here, I'm promising to return it back after 1 year. So what do you think? Which option? Option 1 is risky or option 2 is risky?
Option 2.
Option 2. Why?
टाइम पीरियड ज्यादा है इसमें, अनसर्टेनिटी ज्यादा होगी कि
Whenever the time period extends, so we see the forecasting become very much difficult. For example, in 1 month time period, you can assess, okay, he's my teacher. We have, you can say, a good connection in the semester as well. And within 1 month, the teacher is holding a permanent position in the university. So the teacher will be able to get his salary and you can say, pay me back the 100,000 rupees, right? But if I am asking you that give me 100,000 rupees and I promise I will give you after 1 year, so definitely you will be concerned whether the teacher will be able to keep his salary or keep his contract with the organization for 1 year or not, whether he will be able to earn that much of money within 1 year or not. At the end of 1 year, whether he will be in the position to pay me this 100,000 or not. So we say there are a higher, you can say, degree of uncertainty in time period. So that's why in capital asset pricing model, we keep the assumption that the time horizon is same. Whenever we are talking about time horizon is same, it means the risk exposure become same for all of the security. At least with the, you can say, with the possibility of time, not with the specific, you can say, risk of the security, but the time risk of the security. The fifth assumption is that all investment are infinitely divisible. All investment are infinitely divisible means that we can also purchase a share in portion rather than a full share. For example, though you have seen that we have discussed in chapter number 5 as well, I guess, chapter number 4 to 5, that we have seen that stocks are usually purchased in packs of stock. Like for example, we have seen in Pakistan, it is being purchased with the 500 or 500 multiple, or you can say shares can be traded. But like for example, if you are going with the borrower, so you will be able to buy those, you can say, stock in friction. And right here, this says not only you will be able to buy the stock in friction, you will also be able to purchase a share in friction as well. It means you can purchase a half share as well, right? So this is an assumption. All investments are infinitely divisible, which means that it is possible to buy or sell fractional shares of any asset or portfolio. This is just an assumption. This assumption make, you can say, our calculation possible. Otherwise, if you are not taking this assumption, our calculation will become complex. Number 6, there are no taxes or transaction costs involved in buying or selling assets. This is very important, you can say, assumption, and you would not only see this assumption underlying in the capital asset pricing model or capital as capital market theory, but you will also see that this assumption is repeated in multiple, you can say, financial theories. Most of the financial theory are taking this assumption as common. There are no taxes or transaction costs. You can find out usually the people buy or sell in order to, you can say, maximize their profit. And if you find out there is any tax or transaction cost, you will find out that a smaller portion of profit is usually left over, because the people would not like to trade in order to get that profit, because they will find out that all of this profit will be then dried up because of tax or the transaction cost. So we want to see that we are taking any change in the profit is earned profit. So therefore we are assuming there is no taxes and there is no transaction cost for dealing in the capital market. Although there is transaction cost, we have seen whenever you are buying or selling shares, so the broker will always charge a commission, but we are relaxing, you can say, we are actually restricting that commission in order to understand this phenomenon. So this is a reasonable assumption. In many instances, neither pension funds or religious groups have to pay taxes, and you can find out that there are some, you can say, mutual funds, there are some pension fund companies. For example, in Pakistan, you will see there is uh, old age benefit institution of Pakistan, OBI, something like that. And these, whenever they are investing, you can say their security, whenever they are investing their capital in different security, so they are not by law are required to pay any taxes on the returns what is generated from that capital, what they have invested. So there are other, you can say, groups as well which are relaxed on. Just hold a second, please. Sorry, वो सर अमान की कॉल आ गई थी, तो I had to, you can say, pick that up. So in this assumption, we are assuming that there is not transaction cost or taxes. It means if you are buying or selling any security, you will be not required to pay any tax, and you will be not charged any transaction cost. It means no commission will be charged on your transaction. Second last is there is no inflation or any change in the interest rate. It means in the time period for which we are considering this capital theory, or we will be trying to understand the rate of returns. In these rate of returns, we are considering that inflation will remain unchanged, or the interest rate in that time period or time horizon will remain unchanged. There will be no change in inflation in that time period for which we are trying to calculate the rate of return. And the final assumption is capital market are in equilibrium. Capital market in equilibrium means that already the prices which are assigned to the security is already in form of equilibrium. It means they are actually adjusted for the risk which is being held for that security. This means that we begin with all investment properly priced in line with their risk level, right? If, for example, if you remember, in chapter number 1, we have discussed that there is a relationship between risk and return. This is return and this is risk. And we have usually drawn this line, which was known as security market line, SML. And I have told you in SML right here, this point, it is known as which kind of rate? Risk free
Free rate.
rate. And we have seen that usually this belongs to treasury bill. This
Yes,
belongs
sir.
to treasury bill. Then, for example, right here, we will find out right here there is a little bit of risk premium charge. And for this risk premium, that much of return risk premium is charged for this level of risk, and usually it will be known as for treasury bond. Then we have seen that right here there will be a of triple A category of bonds, corporate bonds, and then we have seen that right here there will be a triple B category of bonds, and right here we have seen then there is a prime stocks, that is shares, and over that there will be a riskier stocks. So what does that security market line have told us? The security market line have told us that as soon as the risk exposure is increasing, so is the return is increasing as well. And you can find out the stocks, that is equity stocks are actually offering the highest return with the highest possible risk which is involved. Whereas for bond, we are considering a lower risk. Why? Because in bonds, there is a principal commitment that after some time period, a principal will be repaid. And there is usually, you can say, a kind of a collateral is attached with the bond as well, that if they does not pay, so you will be compensated with some asset or something. But in the stock, you can say you will find out they are not backed with any asset. You are not promised to be repaid with any principal amount, but you are assured that if, for example, the company is getting liquidated, so you will get the net value of asset, that is by paying all of the liability. If something is left, you will be compensated out of that. So we'll say that is considered to be the highest risk. So this security market line actually says that all of these capital market are in equilibrium. It means that they are actually present on these security market line, that every asset which is uh, holding a higher, you can say, risk are priced on the lower price, and those security which are offering the lowest risk are priced on the higher, you can say, price, or charged with the higher price. So that's why it remain in equilibrium. So these are the 8 assumptions which we have to undertake in order to understand the capital market theory. Now the second point for understanding the capital market theory is the risk-free asset, right? Or on the basis of that risk-free asset, we will be able to understand the risk and return relationship. Now, capital market theory also take that in order to understand that people want to charge a higher return for taking a risk, you need to understand the risk-free asset. And the risk-free assets are which type of assets? These are treasury bills, right? You can see all the treasury bills could be considered as risk-free asset. In order to, you can say, make the understanding of this capital market theory, the second point what the market theory is based on is risk-free assets. And what is risk-free asset? Any asset which have zero variation or that have zero standard deviation, right? Because what is risk? Risk means deviation from its mean. If we are considering any asset which is risk-free, so we will say its return does not deviate from its mean. So if it is not deviating from its mean, it means the standard deviation of that, you can say, security will be zero. And when the security have zero standard deviation, so automatically this security will be holding a zero correlation with all other risky asset, right? If there is a zero standard deviation, so the correlation of this security with all other security will be considered as zero correlation. Why is it is considered to be zero correlation? Because you can recall, if you find out, for example, whenever we are talking about combining two assets for making a portfolio, so we are required to take a product of, that is, uh, return minus expected return of ith security multiply by, this is a deviation. So you remember we had used that in some formula. It is coming in the coming slide. And then we have multiplied with it the deviation of any other security that we are combining. For example, we are combining a security that is risk-free rate. So I'm using RF as a risk-free rate minus the, you can say, expected returns from risk-free rate. And if this is deviation, so we say a deviation is zero. So if I put this value as zero, so zero multiplied by this thing will become, the answer will become how much? It will become zero. So that's why automatically the correlation will become zero for all of the combination of risk-free asset with any risk asset. It means that it does not correlate with any of the other securities. The third point is it provides the risk-free rate of return. Obviously, it provides what? A risk-free rate of return. If it is a risk-free asset and the standard deviation of this asset is zero, so definitely it will provide a rate which will be known as a risk-free rate, and it will always lie on the vertical axis of the uh, return risk graph. And you have seen that, for example, when I was drawing a security market line, so you have seen that this is a point which is known as risk-free rate. So this risk-free rate is always, you can say, contained by which security? The security which is known as a risk-free asset. So risk-free asset will always offer a risk-free rate. It will have no or zero correlation with any other riskier asset or portfolio, and will have a zero standard deviation. इसमें किसी को कोई क्वेश्चन तो नहीं है? ये समझ आ गई? इसमें हमने क्या कहा कि अब हम एक कैपिटल मार्केट थ्योरी को समझने के लिए एक कॉम्बिनेशन ले रहे हैं कि हमारे पास एक रिस्कियर सिक्योरिटीज हैं और कुछ रिस्क